And with us being in, for a while there being in a high inflation environment, you would think, if you don't know any better, that deflation must be good, right? I mean, high inflation's bad, then deflation's good. Exactly the opposite. So deflation is actually a huge negative. Welcome back, everybody. This is the January version of our Monthly Market Matters, January 24. If you've been paying attention, we did end up missing December, but we were in the middle of a move, and we'll talk about that a little bit later. But we are back for January. Just a quick recap of January and basically how the markets have done on a year-over-year basis. So far, January's off to a good start, up about 2.75% for January as we near the end, and for the 1 year number is almost 24%. But remember, on the 1 year numbers, these are going to be big numbers because the previous year was down quite a bit. So again, it's all start and stop date. The NASDAQ's up about just over about 3.25. On the 1 year, it's up 38%. The MSCI World without the U.S. ex-U.S. is down a little bit, about 1.75%. For the year, still up about 5%. The ag is down 1.2%. For the 1 year number, it is actually up now for the first time in a while, so up about 1%. And then commodities, which vary greatly, is up about 0.5% for the month and down about 7% year over year. So that's kind of where we stand as far as the markets go here in January. And then we got a couple of interesting things to talk about and what's driving the markets.
Yeah, I would just say that S&P 500, NASDAQ, all those stock market numbers were all really came to recovery in December and November. I mean, those last 60 days of the year were really made the year as far as stock market gains go, and mostly driven by the same names, the Apple, Nvidia, Microsoft. I think Microsoft just went over $3 trillion in total market value recently. So it's definitely the same, usual suspects pushing the market.
Yeah, for sure. And like anything with the market, it's so hard to time. If you would have got out at the end of September, you would have thought the year was not very good. And then like Chris just mentioned, you have October, November, December, and everything comes ripping back, which again is why we say time in the market's better than timing the market, because you just don't know when sentiment's going to switch.
Yep.
Let's get into
about inflation. Yeah,
a little bit. So core inflation is down. We'll get a little chart for this. So core inflation, what is core inflation? Core inflation excludes food and energy sectors. And the reason for that is those are a little bit more volatile and sometimes can, give a false reading of where inflation is at. And we talk about this all the time. There's lots of different ways to define inflation, but core is generally one that's looked at pretty closely, by the Fed and a good indicator of let's call it real inflation. So it's at 3.9%. So that's the lowest level since August of 2021. Again, remember that inflation and rates are tied together. So, trying to bring rates have gone up, trying to bring inflation down. Remember in August of 21, the Fed fund rate, was at 10 basis points. So that's 0.1%. The Fed fund rate today is over 5.25. So, big difference, but now we're starting to see that decline in inflation. This is a measure of the core inflation, and when inflation comes down, then markets are generally in a better position, and we can probably expect rate hikes to stop and maybe eventually start to decline again. So if you strip out shelter, there's another chart, which is another one that can alter the reading. The CPI is only up 1.9% year over year, and you can see that's quite a big change from where we were at in 22.
Yeah, and I think most of the data there is just rents declining. So it's not necessarily home prices declining, because I think we still have a supply issue, even though mortgage rates are much higher. Supply as far as single family homes is still very low. Not a lot being built, and we'll talk about this a little bit later with some where mortgage rates are. Not a lot of people wanting to give up a 3% mortgage and take on a 7% mortgage just to move. So you still have a lot of choke down supply, and But as far as rents, they've come down dramatically. And I'm not sure exactly why, other than maybe there's some competition in the market. But that really, when you put energy prices together with higher food prices, with accelerating rents, that's where you get those massive inflation numbers, and why the Fed really wants to go in and raise rates and try to choke things off for sure.
Yeah, and we talk about this, we've talked about it a lot now over the last 2 years, but it really is a primary driver of the market. Rates, which are a function of, controlling inflation. I mean, the Fed's one of their number one goals is to control inflation, and they do so. One of their tools they do so with is rates. So this whole why we continue to talk about inflation and where it's at is because that's how the market reacts and looks at, basically outlook. Remember, we talk about the market being a forward looking. It's not what's happening today. It's what they expect to happen, 6 months, a year, 2, 3 years from now. And every time we see these numbers tick down, that gives the market a good indicator. And so again, that last 3 months of last year, we had a pretty good rally, and why this year started off well.
Yep. So are they going to cut rates soon? I guess that's the question, right?
Yeah, I mean, that's right. It's always like trying to project what the Fed's going to do, and what they say they're going to do and what they actually do, or what the market price is in, are two different things. So here's where the expectations are, and this is where you get a little bit of disconnect. We have a Fed funds rate expectation chart here. So the Federal Reserve, so you can see this goes along by month, and it gives you the expected rate, basically what the market's pricing in. And the Fed has said that they think they're going to cut 3 times this year. Again, these are all just projections. Data changes everything. It could change, tomorrow, next month, the following month. But they're expecting 3 rate cuts. The problem is the market's pricing in 6 rate cuts. So again, the market expects the rates to be at 3.89% by year end, where the Fed said, hey, we're going to do 3. And again, this is all crystal ball stuff. They could do none if we get the wrong inflation readings and things move the other direction. But this is where the market is pricing in. So if we don't have a bunch of rate cuts, maybe the market doesn't perform as well. The one thing I did want to point out on this short term, so the Fed controls the short end of the yield curve, which is where you get your cash returns, right?
Yep.
So money market and short-term treasury yields follow very closely to what these numbers are here. So if this holds true, and let's say the market is right and there are 6 rate cuts by year end, you can expect cash to be somewhere under 4% from a money market perspective, and T-bills are going to be very close. Where right now we're over 5% with returns on cash, and T-bills even a little bit higher.
Yeah. So said differently, if we're getting 5% out of money markets right now, then we can expect something like 3.5%. If this chart comes true, 3.5% to 3.25% interest rates on money markets at that time. So, but a lot of this is going to depend on unemployment too. So if we get unemployment to really start ramping up, they'll get to the rate cuts pretty quickly. If unemployment stays about where it is, I don't think they're going to get to the rate cut very quickly at all. I think that chart maybe look very different, 6 months from now, as we approach the presidential election in November too. So a lot of things are all go into that one concept of the Fed just pulling the trigger and starting rate cuts to bring rates back down and get businesses borrowing and get people to start borrowing more money in all kinds of ways to do that.
For sure. So that's kind of the inflation and rates tied together, and that's probably the 2 most important things right now with markets, and Chris brought up employment as well. One interesting area that I know was a hot topic a decade ago is China. Thought we'd just bring up where China's at, and again why diversification, and you never really know what's going to happen. So again, a decade ago, China was the place to be, right? China's going to overtake everything, going to overtake the U.S. economy. So since that point, China's off about 60% off their highs, and Chinese stocks are back below the levels they were at in the late 1990s. So said similarly, or differently, I guess, if you invested all your money in China, you'd actually have the same or less money than you had in the early 2000s. Completely the opposite purpose of investing. So diversification, China, we hold some Chinese positions in some of the different funds that we're in. There's not that all Chinese stocks are bad, but again, the hot dot isn't always, today's hot spot isn't always tomorrow's hot spot. It's the cryptocurrency and all the, back to the tulips and everything that, all these euphorias over the years. And why is that for China? So, number one, communism. I mean, they had, for lack of a better word, draconian lockdowns. I think their COVID lockdown was like 3 years. And if you watch the news, some of the things they did, I mean, they were locking people in buildings and arresting them. And again, that's what you get with communism versus capitalism, democracy. So they kind of do what they want. The other thing that I know I've listened to, I'm not an expert in this area, but China has a really low birth rate right now. Lowest number on record since 1949. So their population declined by 2 million in 2023, and it's a big problem for them. When I was a kid, when Chris and I were kids, it was the Chinese one baby policy. They were trying to slow down growth, and now they've basically hit the other side of it where they can't keep their population up. And I know I listen to Elon Musk all the time say the biggest, whether he's right or wrong is, up to your interpretation. But he said the biggest risk to humanity is low birth rate, and he's a pretty smart dude. So, not that he's 100% right, but low birth rate is becoming a pretty big topic, and China, like I said, they're really hurting to keep their population afloat.
We don't have a chart of this, but the thing that's interesting is the Chinese stock market and some of those indexes are definitely down over that entire period, but their total economy size has still grown and continue to grow. And so the interesting thing is the stock markets tend to reward innovation and growth, and what basically what their market and what the market has done with respect to valuing Chinese stocks is they've just said there's just not enough growth there. We'd look to other places for innovation and for growth, and that's why certain growth names in the United States get rewarded and are bid way up in terms of price and continue to grow. It really has nothing to do with, well, it has less to do with economic size, total economy of China relative to the United States, and more to do with innovation and where the growth is going to be in terms of individual companies. And so I'd be interested to see what their economy size is over that same period of time. I would imagine it's getting really close and maybe even eclipse the United States at this point, but that doesn't mean that that their stocks and their companies are more valuable. It's shown to be less.
Yeah, and I know one of the issues on that was like I said, the lockdowns that I mentioned through 22, and China is actually in a deflationary environment right now.
Right.
And with us being in, for a while there being in a high inflation environment, you would think, if you don't know any better, that deflation must be good, right? I mean, high inflation's bad, then deflation's good. Exactly the opposite. So deflation is actually a huge negative. You have to go through an econ class to understand why, but basically, you don't want prices going down over a long period of time. I mean, for a blip, it's okay, but China's has been in deflation now for I think a year or more, and it's really hurt their economy.
Well, I mean, Japan went into, post 1989, 1990, went into a very, very long, and I'm not sure that they're completely, from just a secular perspective, I'm not sure that they're out of it. They still have have different ways that they're trying to stimulate their economy to get, not just to get inflation, but just to get growth back.
How long has Japan been at zero interest rate?
Since like
Forever.
1989.
Yeah, since 89.
1989.
I think they call it stagflation.
Yep. But again, low birth rate. There's a bunch of different factors that go together. But coming off of a big asset bubble and going into a situation where you just can't spur growth, no matter how low the interest rates are. So anyway,
yeah, low birth rate is I know is a really big factor, and like I said, it's interesting how that's starting to play out, especially like I said with China and that whole one baby policy that we grew up in, and now they've completely hit the other side of that, and trying to get people to have kids, and they just can't. I think they're right now at like one. There's like one kid per family, and why they can't sustain their population.
Yeah, that's bad for overall for an economy.
Okay, so timely topic. I'm gonna have Chris talk about this, but we get this question all the time, and the answer is different depending on where we're at in markets and rates and everything. But should I pay down my mortgage? Again, this is a pretty common, like, I'm retiring, I've heard you have to pay down your mortgage. Dave Ramsey told me I need to pay off my mortgage. You want to talk a little bit about that, Chris?
Well, I think just to frame it properly, what we get in terms of questions from clients is, hey, I have $150,000 left on my mortgage. Why don't I just pay it off, and then my payment goes away, and I don't have to worry about it. And there are different, again, you talk about trade-offs all the time. There are definitely trade-offs, but what happens at the tail end of a mortgage, with a typical amortized, let's say 30-year mortgage is, and a lot of people, I'm not breaking any news to anybody, a lot of people know that you pay mostly interest on the front end of a mortgage. If you look at your payment, your very first payment on a 30-year mortgage, maybe 96% or 97% of that total payment is all interest. And so what people forget, though, is as you've been paying all that interest down over time, when you get to the other end of the mortgage, 96 or 97% of it is now principal. So you're paying almost no interest. And what we struggle with and sort of go back and forth with is, hey, yeah, you can take that extra $150,000, $250,000, whatever it is, and out of your investments or out of your cash pile and pay down your mortgage. There's nothing necessarily to stop you from doing that. But from a what is wise financially standpoint question is, with rates as high as they are on cash, and given that you are probably locked in at a fairly low interest rate at the very beginning, and the fact that you're just not paying very much interest now, the cost, the opportunity cost of taking that cash and putting against your mortgage and not having a payment, although seems like you can sleep well at night, I'll remind people you still have to pay property tax and your PG&E bill or energy bill and all the other things that go along with it.
You still don't own the house.
The old paid off house. I don't know anybody that can just stop making any payments toward their house. There's always something, but from a relative size, from a cash flow standpoint, for a lot of people, it's not a big issue. And giving up $10,000, $12,000, $15,000 in income a year on that cash pile just to put it against your, almost costing you nothing from an interest standpoint, payment, just doesn't make a lot of sense for most people. Not everybody's in the same boat. Some people, we are working with, right?
It doesn't make a lot of sense.
And one of the charts we have here is, it's going to be interesting because right now, and this is a little bit of an old chart. This is about a year old, but I'll tell you, there haven't been a massive number of...
Hasn't been a lot of refis, has there?
New refis or mortgages originated in the last year. So this is going to be pretty dang close. But something like 60+% of all mortgages are under 4%.
And remember, cash is at 5%. So if you just don't pay off your mortgage, you pay your lower than 5% rate, which could be in the 4s or even in the 3s, some in the 2s, and you just have your cash and money market, you're actually making money. So you pay the mortgage, you put the cash in, like I said, in a money market instrument, you're paying less than 5%, you're making 5%. That's net positive. You're just making money to not pay off your mortgage.
Right. And again, what I'm mostly talking about is, late stage mortgage. As people are approaching retirement, and they start to really think about things like, cash flow and what's going to happen when I retire and how's this going to pay. So I think about it this way: great ideas at the front end when you're buying, large down payments. We're not big fans of just spending money on interest. That's giving money away. That's not what we're trying to say. But early on in a mortgage process, large down payments, paying down principal at the front end, recasting, something called a recast. If you make a large payment toward a mortgage, where you can basically reset your payment, so that oftentimes with fixed mortgages, you have one, maybe 2 times you can do this over the life of a mortgage, where say it's a $500,000 mortgage, and you put a $200,000 chunk down because you sold something or whatever the case may be, and now you have a $300,000 mortgage. They will actually redo your payment and recast it over the remaining life of the loan. you make extra payments. All that is really good at the front end to reduce overall interest cost. But when you get down to the end where interest deduction is dwindling, there's, people, I think it's almost like financial boredom. They go, it's just not, I don't know if it's worth having that around anymore. And
like a nuisance.
Again, what you give up is you give up, potential for a lot of income. And there's no difference, by the way, in market, market performance of, two houses that sit right next door to each other. And one guy, and one family has, an 80% loan to value on their house, and the other
giant
one's
mortgage, no mortgage, yeah,
and the other one's paid off. There's
Same.
no difference. Those if they're the same house, the same square footage, the same, if they sat on the same piece of property, it doesn't matter how much you owe on the house. The value of the house is going to go up and down based on the market. And so, a lot of people think, well, I'm putting equity into my house. Well, no, you're just moving it from one side of your balance sheet to the other. That's all you're doing. You're not creating anything or destroying anything. You're just moving things. And so,
like we said, the individual situation, we're happy to talk to you about it if it makes sense. But like Chris brought up there at the end, if you've dealt in real estate at all, you know how difficult it is to get money out of real estate. So if you put all your cash, we deal with this quite frequently where people are asset rich but cash poor. You got all kinds of assets and they're worth money. That's great, but if you have no cash, there's a lot of things that only take cash, including the government. So you put all your money in the house, and then all of a sudden something happens, and you need the money back out. I mean, it's the great question. Like, why can you get 80%, an 80% mortgage? You put 20% down and get an 80% mortgage, but if you have your house paid off, they won't give you 80%. You want to get a cash out refi, you can get 70 or 60. So it's very difficult to get money back out of the house, which, again, not that you shouldn't continue to make your payments and eventually pay it off, but to just jam all your money in there, then if something happens, it gets a lot tougher to get that money back out. Yeah. The other thing that I wanted to mention, and I don't know if people think about this, but again, this is the way we're, this is what we do, this is the way we're wired. So if you're a spender, right, investor or a spender, inflation is not a great thing. And we've seen that, right? When you go to the gas pump and gas is here in California, $5 a gallon or $5.50 or even more. As prices go up, your dollar doesn't go as far. But on the flip side, if you're a fixed rate borrower, it's a great hedge against inflation. So if you bought your house for, around here, maybe it's $500,000, bought your house for $500,000 and you owe $400,000 to start. And we have massive inflation over many, many years. Well, you still only owe $400,000. So your dollars go a lot far. Again, you have more dollars because of inflation, and you still owe the same amount. So when you're a borrower, inflation works to your benefit. Not that we necessarily want it, but it's good to have things that are a hedge against inflation. So that's one thing that I think people don't think about is having a mortgage can be a hedge against big inflation.
Yeah, and just again to put it in somewhat real terms, if you're if you've owned a house at this point for 28 years, you have 2 years left, on your mortgage. Your mortgage payment, principal and interest, may be $1,000, $1,100. I'm just picking some numbers out. And now, if you had to go buy your house back, do the same size mortgage, do all this stuff, your payment may be $4,500 or $5,000. And over that 30 years. Your wages have risen, right? Everything else has risen except for your mortgage payment. So here we are saying, hey, don't pay off your mortgage. And part of the reason is it's not as expensive as it was at the beginning because of inflation. All prices have risen except for one price, the price that you pay to live in your house, and that's a huge advantage as time ticks on.
So yeah, I mean, again. Great discussion around mortgages. There's lots of factors, and like I said, every situation is different. But just give you some other things to think about. So upcoming from SVWP, let me. First thing is we're hoping here in February we'll do our quarterly roundtable with our new podcast studio. Again, we mentioned we moved, so that was a little bit of undertaking. It's always fun to move. Everybody who's moved knows that. So we did get into the new place, a little bit more space, and like I said, a podcast studio. Here's a map.
Oh, thanks, Becca, for the map.
Yeah,
That's great.
awesome. So you can see we're really far away. It's just down around the bend. In fact, we used to walk it back and forth as we were getting ready to move. I think it's 0.2 miles. So as you come around the bend, we're the first building instead of the second one. Suite 205 instead of 103. So either take the elevator or walk up the stairs, but we're right there on the right-hand side as you move up the building. But we do, like I said, we do have a new podcast studio. We're excited to use it. I think it'll be a much better format. I mean, we love Hollywood Squares here, but I think it'll be better if we're all sitting around and getting to yak it up a little bit, and it'll be a better format and better conversationally. So that's what we're looking forward to. Like I said, we only missed one here in December, so we're back on track with January, and then February is our big roundtable. We'll get the other guys in here and do a little bit more.
That'll be great.
Thanks everybody for joining us, and we'll like I said, hopefully see you from a new location here in February.